All right, that is the Reserve Bank of India governor, repeatedly talking about how there is no letting go of oversight when it comes to financial stability with this, 22 other measures that have been announced, relaxations for the banking sector primarily. There will be enough guardrails that will be put into place when all of these regulations are announced, and it will only be done after public consultation. But that said, I mean, this is a big shift coming in, from the spate of regulatory tightening that we've seen in the previous few governors' regimes. Whether this is capital market financing, removing limits, allowing acquisition financing, lending for IPOs against debt securities, or easing the risk weights. RBI has said for MSMEs, residential real estate, for NBFC lending to infrastructure, all of these mark really a sea change, a large exposure framework easing that also that the RBI is talking about. So you had the RBI top brass addressing that, and of course back to the policy, the pause that has come in expectedly with the RBI leaving room for more rate cuts on the table by saying that the lower inflation print does open up some space for action in the future. On that note, let me welcome our esteemed guests on the show. Neeraj Gambhir, Group Executive and Head of Treasury Markets and Wholesale Banking Products at Axis Bank, Pranjal Bhandari, Chief India Economist at HSBC, and Soumyakanti Ghosh, Group Chief Economic Advisor at State Bank of India. And also with us for these banking regulations is Anil Gupta, Senior Vice President and Co-Group Head at ICRA. Thank you so much, all of you, for joining us here. Anil, let me start with you before I go to the economists. This series of measures, banking reforms as the RBI is calling them, that it has announced, whether that is, the overlapping businesses that, RBI has left to the discretion of boards, allowing, acquisition financing, lending for IPOs against debt securities. What do you make of these changes and the kind of additional credit this will unlock for banks to capture back market share from other financial players?
Yeah, thanks. So it's difficult to quantify maybe the incremental credit flow which may flow because of these relaxations, but definitely the measures which have been announced are in the backdrop of slowing bank rate growth, and all these measures, maybe especially the enhancing that removal of the circular on enhancing the borrowing through market mechanism for large borrowers, that is going to have maybe a favorable impact in terms of maybe credit flow, because that circular especially involves maybe larger corporates to borrow maybe 50% of their incremental borrowings through market mechanism. While that is possible for larger well-rated companies, but for large maybe companies which are rated in lower rating categories, it becomes difficult for them to raise 50% of their incremental borrowings from the capital market. So that should improve the credit flow to these corporates and should be beneficial for the overall bank credit.
Anil, let me specifically get from you some of the names, for instance, and forms of business, this circular being withdrawn. HDB is the clear standout beneficiary. For other banks, who are the ones that stand to benefit?
So, like all the large banks will have subsidiaries operating into, let's say, insurance, NBFCs, capital market businesses, merchant banking activities, broking. So while maybe some of these businesses, let's say, are not overlapping like insurance, capital markets, but the major concern was on the lending piece, which is done by through the NBFCs of these large banks. I think the intention is basically to give the free hand to these banks to continue lending, because see, these banks operate and cater to different customer segments through bank and their subsidiaries. These customers may require maybe a different kind of a setup. Even the employees which are working in these subsidiaries may have a different skill set. The branches which these subsidiaries will have a different skill set, a different setup. So basically, working the same product which is being catered by a subsidiary through a bank is very, let's say, less feasible. So that gives a lot of headroom for these banks to maybe cater to a wider segment of the customers and in wider product segments also.
Well, Anil, hold on. I'll come back to you in just a bit. Pranjal, quickly, your takeaways. The pause, as expected, has come in, and the RBI does seem to have left room for rate cuts in future.
Yes, absolutely. Going into the meeting, we were forecasting a dovish pause, and I'm still surprised at how dovish the pause was. A couple of reasons. One is the commentary on inflation, the fact that, they said clearly that there has been significant moderation. They've cut all kinds of inflation forecasts for FY26, first quarter FY27, fourth quarter FY27. Similarly, with growth, they've mentioned clearly that growth is below aspirational levels, and then they've cut the second half of the fiscal year growth numbers as well. It can be asked whether does that mean they will cut or not, and my sense is they gave both direct and indirect indication that they are open for more easing. One is that they said that more space for easing has come up. The governor also said that this is communication, but we also want to follow it up with credible action. So I think that was sort of a direct inkling that, some rate easing could come in the future. And I think there was some indirect way of communicating that as well, with 2 of the 6 MPC members actually preferring a accommodative stance at this point of time. I think that's a really big signal. So all of this makes me feel that if, we go into December policy and the 50% tariff is still there, and I think that's the main thing here, the 50% tariff, if it's there, then I would say that there could be easing in December and also in February. But I think a lot depends on the tariff rate at this point of time. Quickly, one more thing. I think the governor also said in his in the press conference right now that at this point of time it is not clear, but over a year, I think it will be clear to them that the negative impact of the high tariffs can be more than the positive impact of GST tax cuts. And that is why they have brought down their second half of fiscal year GDP growth numbers. So if that were to be the case, then I would say that December is going to be a rate cut.
Okay, Pranjal, that was quite comprehensive. Thank you. I mean, that is a list of things that makes this policy sound more dovish than we'd expected. Soumyakanti Ghosh, you had gone into this policy expecting a 25 basis point cut, which has not come. What is your base case scenario? We don't know how the tariff negotiations will go. What happens in December and thereafter?
No, thank you, Ritu. I think the policy is, if I look into this policy is basically very balanced communication in terms of rate space opening up in the future. But beyond the rate cacophony, this policy is actually beyond the rate cacophony, and it is actually a very good policy in terms of addressing the market microstructure. And if I have to borrow Ben Bandanke, it's constant policy discussion that is based. I think all these measures which we have mentioned in terms of the large exposure framework, the deposit risk insurance premium, and also the mergers and acquisition will do 2 things. First, it will increase the bank lending significantly, and also it will come at an affordable cost, because the transaction cost will also decline because of the many complexities around this circular. I don't want to get into the details, but the point is that, so this will serve the purpose of not only making the regulations more transparent, more constant, but also it will move in the direction of reducing the transaction cost of the banks. Now, having said that, coming back to the policy, I think if you look into the policy inflation projections, it was 4.2% at the beginning of this year for this current fiscal. Now it has been reduced to 2.6%. So there is a 160 basis point reduction. On the growth front, we moved up to 6.7. Now we have moved, then we came down to 6.8. Now we have moved back to 6.8. And if you actually very closely look into the RBI inflation revisions and the GDP revisions over the last 7 to 8 years, you will find a distinct pattern that even if the RBI inflation projections have been downwardly revised, but if the GDP numbers are not adjusted, the rate cut doesn't come in the policy. So possibly if you look into the numbers right now with the GDP growth rate being adjusted in the second half, I think that will open up space for possible rate cuts, maybe in December, maybe in February. The timing we can always debate. But as of now, I think the policy is clear in its communication that inflation is headed down, and the only way why the rates have not been cut in this policy is one to look through the prism of uncertainty. But the question remains there that even if we may wait for the uncertainty to recede, there is no guarantee that it will recede in the next couple of months. So it can actually increase. So it can cut both ways. But my sense is that the policy has given enough indications of further easing in the next couple of months.
Okay, thank you for that. We have to take a mandatory break. Mr. Neeraj Gambhir, when we get back, we want to ask you about how the bond markets have, absorbed this policy. But we have to take a break. Back in just a moment to continue this discussion.